UnitedHealth Group definitively beat consensus estimates across the board this morning. Top-line revenue came in at $112 billion for the second quarter.
Yeah, which is just a massive number to process.
Truly. And it gets better. Adjusted earnings per share hit $6.38. Plus, management just bumped up their full-year 2026 EPS guidance to a range of $19.50 to $20 a share.
Right, which is exactly why we are seeing shares reacting so positively in early trading. Wall Street loves a raised guide.
Oh, absolutely. But I mean, imagine running a business where you intentionally kick nearly 1 million of your customers out the door, and Wall Street actually rewards you by raising your valuation.
Yeah, it's wild. It's the ultimate paradox of modern managed care, right? I mean, shrinking your actual customer base and key demographics just to grow the bottom line.
Which they did, operating with a massive 4.9% net margin on that $112 billion in revenue.
Exactly. And, for a company of this sheer size, moving the needle on margin by even a fraction of a percent, it requires enormous operational leverage and just ruthless calculation.
So, for you listening, whether you're managing a portfolio, prepping for a healthcare sector allocation meeting, or you just want to understand the underlying mechanics of how the dominant player in U.S. healthcare is currently operating, our mission today is to decode this specific financial puzzle.
Because it really is a puzzle.
It is. How does a company actively lose hundreds of thousands of members from its insurance rolls, yet somehow translate that exact membership exodus into massive margin expansion and raised guidance? Okay, let's unpack this, because to understand the how, we really have to start with the headline numbers.
Right, and one metric in particular.
Yeah, we established the $112 billion in revenue, but the number that just jumps off the page to anyone who models health insurance is the MCR.
Yeah.
The medical care ratio.
Yeah, and for those tracking the space, I mean, the medical care ratio is just the percentage of premium dollars that an insurer actually spends on medical claims, right?
Yeah.
As opposed to keeping it for administrative costs or profits.
The lower the better for them.
Exactly. It's the absolute core metric of profitability for the insurance side of the business.
So in Q2 of 2025, UnitedHealth Group's MCR was at 89.4%. But this quarter, Q2 2026, it dropped significantly, down to 86.7%.
It was just a huge move.
A 270 basis point drop year over year on over $100 billion in revenue. That is a tidal wave of capital falling straight to the bottom line.
It really is.
But okay, let me put on my retail investor hat for a second here. When I hear that an insurance company is spending a smaller percentage of premium dollars on actual medical care, my immediate cynical reaction is to assume they're just denying more claims to juice these earnings. Like, are they just saying no to more doctor requests to force that ratio down?
Well, what's fascinating here is that the drop in the MCR isn't just a blunt instrument of denying care. The mechanics are actually far more structural than that.
Oh, really?
Yeah, according to the report, the decrease is largely driven by what management is calling benefit design and pricing discipline. But, and this is key, there is also a highly specific accounting factor at play here.
Okay, what kind of accounting factor?
A massive $860 million in net favorable prior period development. That's primarily related to 2026 dates of service.
Wait, let me try to translate that into personal finance terms to see if I have the mechanics right.
Go for it.
Is this prior period development basically like me overestimating my tax burden all year, taking too much money out of my monthly paycheck, and then getting a massive, unexpected refund check from the IRS in April that suddenly makes my Q2 personal budget look amazing?
That is actually a perfect analogy, yeah. Because when you go to the doctor, the claim doesn't process instantly, right?
Right.
So insurers have to estimate and reserve cash on their balance sheet for medical claims that have been incurred by patients but just not yet reported or processed by the system.
But they set aside a bunch of cash just in case.
Exactly. And what UnitedHealth is reporting is that the actual cost of care came in $860 million lower than they had conservatively modeled.
So they anticipated higher medical utilization across their patient population. They priced their premiums aggressively to cover that potential spike. And then when the actual medical claims came in softer than expected, boom, that massive reserve gets released straight back into earnings.
Bingo. And that ties directly back to their pricing discipline. They're pricing their risk much more accurately this year, ensuring that the premiums they collect more than adequately cover the statistical risk of the populations they're insuring.
Though if we look at the expense side, their operating cost ratio actually ticked up slightly, right? Moving to 12.7% this quarter.
It did, yeah. But that increase in operating costs is being driven by heavy targeted investments. I mean, they are pouring capital into physical care delivery enhancements, infrastructure, and crucially, artificial intelligence.
Right, the AI boom.
Yeah, they are spending significant money right now to build the technology that will ultimately automate back office functions, which lowers administrative costs down the road.
And they can comfortably fund this whole technological arms race because their cash flow from operations was incredibly robust.
Yeah.
It came in at $11.1 billion in the quarter.
Yeah, 11.1 billion is just staggering. And they get there by aggressively shrinking their risk pool, which protects those margins and generates that cash.
Which means to really understand this pricing discipline, we have to look inside the insurance segment itself, UnitedHealthcare.
Yep.
Because this is where the strategy of addition by subtraction is playing out in real time. UnitedHealthcare, the benefit side of the house, reported revenues that were essentially flat year over year at $86 billion.
Flat revenue, but look at the margins.
Right, flat revenue, yet their operating margins nearly doubled, jumping from 2.4% in Q2 2025 to 4.6% this quarter. Earnings rocketed to $3.9 billion. And they achieved this by literally serving fewer people.
Yeah, total consumers served dropped by 525,000 sequentially, bringing their total rolls down to 48.5 million.
It's like a nightclub bouncing its less profitable patrons to increase the average bar tab.
That's exactly what it is. But we have to look at the underlying demographics of exactly who they are shedding to understand the strategy.
Right. Where are the losses coming from?
Well, in the employer and individual segment, they lost 145,000 members just due to expected attrition. In the community and state segment, which manages Medicaid populations, they lost 380,000 members.
And a big chunk of that was Louisiana, right?
Exactly. A significant portion of that Medicaid drop was their planned exit from the Louisiana Health Plan, combined with those ongoing state-level Medicaid eligibility checks we've been seeing.
But the number that completely shocked me is in Medicare and retirement. They have lost 965,000 seniors from Medicare Advantage and complex population programs since the end of 2025.
Yeah, almost a million.
Nearly a million seniors gone. I mean, Medicare Advantage is widely considered as a great demographic growth engine for managed care, given the aging baby boomer population.
Right.
I look at a loss of 1 million covered lives in that specific demographic, and it sounds like an absolute disaster on paper. Why is Wall Street viewing this massive contraction as a strategic win?
Well, if we connect this to the bigger picture, you'll see that this is a highly deliberate response to changing government economics. I mean, Medicare Advantage is incredibly complex.
Yeah.
The government pays private insurers a set amount per senior per month, and that payment is risk-adjusted based on how sick the patient is. But over the past few years, CMS, the Centers for Medicare and Medicaid Services, has been aggressively tightening those base payment rates.
Oh, so they're overhauling how they calculate patient risk.
Exactly. The coding intensity adjustments have changed.
I see. So if a patient has a specific set of chronic conditions, UnitedHealth used to get paid a premium rate, but now CMS is changing the rules to pay less for those same conditions. The fundamental math of the contracts is breaking down.
Yeah, the math got significantly harder, which just squeezed the margins on those specific populations. So UnitedHealth Group is basically demonstrating to the market that they are absolutely willing to walk away from unprofitable government contracts.
We see it with the Louisiana Medicaid exit.
Right, and we see it in their willingness to shed complex Medicare populations if the federal funding no longer aligns with their internal margin targets. I mean, they are actively choosing profitability over market share.
Which is wild for a growth stock.
It is, but they will not chase top-line revenue or hoard patient volume if it degrades that 4.6% operating margin.
That is the ultimate display of pricing discipline. If the government premium doesn't cover the actuarial risk plus UnitedHealth's required profit margin, they just pull the plan from that county. Yeah. Or they price the premiums and deductibles in a way that intentionally encourages those members to shop elsewhere.
Yeah, they let them walk.
But this creates a massive downstream problem for their internal services arm, Optum.
You would think so, yeah.
Because UnitedHealthcare and Optum operate symbiotically. You cannot shrink your insurance footprint by nearly 1 million seniors without starving your own Optum clinics and Optum Rx pharmacies of patient volume. I mean, you'd expect Optum to take a massive hit this quarter.
Yet the exact opposite happened.
This is crazy.
The Optum segment generated $65.7 billion in revenue and $4 billion in earnings. They actually expanded their operating margins by 160 basis points year over year, despite the membership exodus in the insurance arm.
Here's where it gets really interesting. Let me look at these Optum Rx numbers because the paradox here is just wild. The earnings report explicitly states that adjusted scripts dropped from 414 million down to 387 million.
Yeah, a massive drop.
They processed 27 million fewer prescriptions this quarter, specifically because of the membership declines within UnitedHealth Group. But earnings for Optum Rx rose to $1.5 billion. If you're processing 27 million fewer transactions, the only way earnings climb that aggressively is a major shift in unit economics.
Right. And the earnings release explicitly points to specialty generics adoption as the driver there.
Specialty generics.
Yeah, what we are witnessing across the entire Optum portfolio is a structural shift away from pure raw volume and a pivot toward higher margin specialized services. I mean, specialty drugs, even the generic versions of complex biologics, carry significantly different economic profiles and rebate structures than your standard run-of-the-mill maintenance medications for like blood pressure or cholesterol.
So they process fewer total scripts, but the scripts they do process generate significantly more profit per unit. It's the exact same addition by subtraction dynamic we just saw in the insurance arm replicated in the pharmacy benefit manager.
Precisely. And we see that identical mechanism play out in Optum Health too, which provides direct patient care through their own clinics and physician network.
Right.
Optum Health revenues actually decreased 5% year over year. The report notes they served roughly 700,000 fewer value-based care patients.
And just to remind everyone, value-based care means the provider takes on the actual financial risk of the patient's overall health, right? As opposed to just getting paid fee-for-service every time they run a test.
Exactly. If the patient stays healthy and costs remain low, the provider keeps the difference as profit. If the patient gets very sick and requires expensive hospital stays, the provider eats the loss.
So Optum Health drops 700,000 of these specific risk-bearing patients. Top-line revenue falls. But Optum Health's operating margin increased to 5.1% and earnings hit $1.2 billion.
Yeah. By shedding the specific value-based care populations where the cost of care was exceeding that flat monthly payment, they immediately eliminate their highest loss contracts.
They shed the volume they couldn't manage profitably and squeezed more efficiency out of the healthy populations they kept. It just highlights the incredible resilience of their two-sided business model. They simply do not need maximum patient volume to achieve maximum profitability.
And that efficiency is supercharged by the third pillar of Optum, which is Optum Insight. This is their data, analytics, and technology arm.
Right, the tech side.
Yeah, Optum Insight brought in $5.4 billion in revenue this quarter. They finalized the acquisition of a company called Allegis in July, which expands their consumer-directed healthcare account capabilities managing things like health savings accounts. But the real operational story with Insight is their aggressive rollout of AI-enabled products across the enterprise.
Yes, the report specifically mentions autonomous coding and digital prior authorization tools. They are building and deploying the software that completely automates the administrative friction in healthcare.
Which is highly lucrative.
But extracting these kinds of margins from the American healthcare system, I mean, doubling margins while shrinking patient roles and automating administrative denials, it makes you a prime target for lawmakers and regulators.
Oh, absolutely. When you are the largest healthcare company in the world and your profits are soaring while healthcare affordability remains a daily crisis for the average consumer, you have to manage your public narrative and your regulatory exposure very, very carefully.
And manage it they are. The earnings release reads almost like a political campaign platform in certain sections. I mean, CEO Stephen Hemsley's opening, quote, isn't just a standard victory lap about EPS beats. It focuses heavily on, quote, improving both affordability and the healthcare experience for patients and care providers, and applying modern technology to create real improvement for people.
Yeah, that corporate rhetoric is backed up by a very aggressive, highly publicized set of commitments outlined in the report. They are clearly executing a strategy to get ahead of the regulatory curve.
So let's run through the mechanics of these initiatives, because they are substantial. First, they are committing $1 billion to the UnitedHealth Foundation, specifically focusing on rural health, maternal and children's health, and behavioral health.
All major hot-button political issues.
Exactly. Second, and this is the one that really caught my eye, they are committing to voluntarily eliminating and rebating profits from individual Affordable Care Act coverage offerings in 2026. They are literally going to return money directly to about 1 million ACA members.
Yeah, and they explicitly position that rebate as returning money to consumers while Congress works toward longer-term legislative solutions for ACA stability.
It's quite a flex. They are also overhauling prior authorizations, which is the #1 complaint of doctors nationwide. They are committing to eliminating 30% of current prior approval volume by the end of 2026.
Which doctors will love.
Right, and they are cutting 2/3 of prior approvals for pediatric care. They're expanding their Gold Card program, which basically exempts historically high-performing medical providers from needing routine approvals entirely.
It's massive.
And on the pharmacy side, they're launching a transparent, fee-based care model that decouples their revenue from drug list prices. Plus, committing to a 100% pass-through of manufacturer drug rebate discounts directly to clients by January 2028.
It is just an overwhelming list of consumer and provider-friendly actions designed to generate positive headlines.
So what does this all mean? Did the board of directors just wake up, look at their $8 billion in quarterly operating earnings, and suddenly feel generous? Like, how does unilaterally giving up profit on 1 million ACA plans and slashing their own prior authorization requirements actually benefit shareholders?
Well, this raises an important question about the difference between corporate altruism and strategic self-defense. Because to understand the underlying mechanics of these moves, you have to read the forward-looking statements section buried at the very end of the financial report, the risk factors.
Right, the legal fine print where they are forced to disclose every material threat to their business model.
Exactly. And buried in that list are some glaring regulatory risks that threaten their core profit engines. They explicitly mention the Department of Justice's legal actions concerning their participation in the Medicare program. They also highlight changes in the CMS Star Ratings program, which dictates bonus payments.
Wait, pause for a second. You just mentioned the DOJ and CMS risks, but I also see risk adjustment data validation audits listed in that section. I need you to translate that. What exactly is a data validation audit in this context? Is it just a routine paperwork check, or are we talking about a material threat to their earnings?
No, it is a massive material threat. Remember how we discussed that Medicare Advantage pays UnitedHealth based on how complex and sick the patient's codes are?
Yeah.
Well, a risk adjustment data validation audit, or RADV, is when CMS physically pulls the patient's medical charts to verify that the complex codes UnitedHealth submitted actually match the doctor's notes.
Oh, wow.
Yeah. And if CMS determines the insurer exaggerated the patient's illness to secure a higher premium payment, they don't just issue a fine, they extrapolate that error rate across the entire contract and claw back billions of dollars in past payments. Billions.
So the regulatory threat isn't a slap on the wrist. It's an existential threat to the cash flow generated by their Medicare Advantage populations, which means these voluntary reforms, the billion-dollar foundation pledge, the ACA rebates, the Gold Card program for doctors are essentially a strategic preemptive moat.
It is a brilliantly constructed PR and legal moat. By voluntarily increasing pricing transparency, proactively cutting red tape for doctors, and publicly supporting rural hospitals, they are attempting to preempt federal regulatory crackdowns and antitrust scrutiny.
Makes sense.
Right. If lawmakers drag the executive team to Washington to complain about the burden of prior authorizations, UnitedHealth doesn't have to defend the practice. They can point to this earnings report and say, "We agree," which is why we are already voluntarily eliminating 30% of them and leading an industry-wide effort to standardize the rest.
Wow.
And if they are attacked on pharmacy benefit manager transparency, they just point to the 100% rebate pass-through by 2028.
They are strategically regulating themselves on their own terms and timelines before the government does it for them with a much heavier, less profitable hand. They dictate the pace of reform.
Exactly.
But it's not just legal and government risk they are warning investors about, right? The forward-looking statements also highlight operational vulnerabilities that tie directly back to the technological arms race we discussed with Optum Insight. They explicitly flag the threat of cyber attacks, privacy and data security incidents, and the failure of their technology products to operate as intended.
Yeah, and most notably in this quarter's release, they specifically list the risks and uncertainties associated with their increasing development and use of artificial intelligence and other emerging technologies.
Which brings us to a final thought for you to mull over as we wrap up this analysis. UnitedHealth Group is aggressively leveraging Optum Insight to win a war against the sheer administrative weight of the U.S. healthcare system. I mean, they want artificial intelligence executing autonomous medical coding. They want digital algorithmic tools handling those remaining prior authorizations. They are rapidly removing the human element from healthcare administration to boost margins and achieve that incredible financial efficiency we saw in the numbers today.
And it's a big But as they automate those massive administrative systems, they inherently consolidate their operational risk. A healthcare infrastructure that is heavily reliant on autonomous AI and digital pathways is a system uniquely vulnerable to systemic shocks.
Yeah.
Whether that manifests as a massive targeted cyber attack shutting down their payment networks, or a fundamental flaw in an algorithmic model that misprices risk across millions of patients simultaneously.
So as UnitedHealth increasingly removes the human element from the back office to drive these record profits and offset their shrinking patient rolls, the question is, will this artificial intelligence prove to be their ultimate competitive advantage or their biggest, most catastrophic vulnerability?
It is the operational tightrope they have to walk to keep hitting that $20 a share guidance.
All right, that is our deep dive on UnitedHealth Group's Q2 2026 earnings. Be sure to follow the show for your daily dose of earnings coverage and financial deep dives. We will see you next time.